Right. Hello, everybody, and welcome to the Gulf Intelligence Daily Energy Markets live video podcast on Friday, 28th of April, 2023, at the end of a bad week for crude, the second bad week in a row. Brent this morning standing at around 78.7, a smidgen up today, but down about 3.5% on the week, with all the pressure seemingly downwards. Let me welcome back three old hands on the podcast show to discuss that and some other interesting things. First, Rachel Ziemba, welcome back, founder of Ziemba Insights and adjunct senior fellow in the Energy, Economics and Security program at the Center for a New American Security, normally based in New York, but at the moment on the west coast of the US. Mark Oswald, Chief Economist and Global Strategist at ADM Investor Services International in London this time. He's always in a different place in my experience, Mark, but he's in London now. And Osama Rizvi, Energy and Economics Analyst at the Primary Vision Network in Lahore, Pakistan. Welcome, the three of you.
Thanks for having us.
Let me start with you, Rachel. This week, as I said, has seen pretty relentless downward pressure on Brent and WTI. But I can't actually see how this week was hugely different from the previous week, or indeed the week before that. There was no big economic or financial shocks, no new data apart from a slightly disappointing Q1 US growth figures came out last night. But it seems just to have been a steady piling on of recession fears, demand worries, concerns about oversupply, maybe. What do you think? What's the reason for this slow decline of crude?
Sure. So I think the story this week was about crude being infected by global liquidity, global financial news. And sitting here in the US, I think the big story was not only this sort of growth story that is mixed, but really these renewed worries about financial stress around First Republic Bank and the like. Some of this in some ways is old news being revealed, right? Deposits continuing to flee, the fact that this has not been resolved. I do think that what US authorities have done has to reduce the acute risks that we were worried about some weeks ago. But I do think we're sort of in an environment where rising debt service costs and other financing costs are going to mean sort of weaker US growth. I also think in the US context, there's also this looming worries about debt ceiling. Will there be a default and the like? Now that is far from priced in. But I think this is really a story of global financial worries infecting the oil market. We saw equity markets down again on average, a modest amount. But some real sort of sell-offs in parts of the financials. And I think just really this question mark of exactly how strong is Chinese demand. So all in all, it adds up to, not that different a macro environment, but this sort of question mark ahead of, is the economic weakness going to be enough to make the Fed stay its hand? I'm still not sure that that's the case. And so I think that means the focus on the financial side as opposed to the underlying sort of growth and the fact that the demand is still relatively robust.
Right. Interesting. Financial seems to be the main concern rather than global macroeconomic for a change. But you mentioned China there. And let me go to Mark, because I know that you have a good take on these things. Mark, what is driving it down? And in particular, how big a factor is China in all this? Are worries about Chinese growth the main reason behind the fall, or is it the other factors that Rachel highlighted there? Finance, economics, what do you think?
I think part of it is actually just purely a perspective thing. In other words, there were a lot of very overblown expectations about what China would do this year. It's improving. It's going to be slow. It's going to be, not what people want. This is really what we're boiling down to. People want to see wham, bam, thank you, ma'am, from China. They want to see all that strong demand in terms of energy and commodity imports. and it was never going to happen that way. China has set out its stall. Whether it achieves it is a completely different thing, but it set out its stall. It wants to have much more domestic production, and we know that the consumer in China is still bearing the scars of the property debacle. Elsewhere, it's pretty much the same thing. We went through the SVB and Signature Bank collapses, and then everything seemed to calm down as we went through the end of Q1, and then we got into Easter, and so we forgot about everything. And then suddenly First Republic Bank comes back to haunt us. It's one of those things where you say, right, do we have a financial crisis in the way that we did in 2008-9? No, we definitely don't. Do we have an S&L crisis as per 1985 to 1995? Probably, yes. It's not quite as acute, but First Republic Bank is very much different in relative to SVB, because SVB was just appalling risk management. I would say to a certain extent, First Republic Bank is race to the bottom. Let's give lots of interest rate only mortgages to very rich people in California. And guess what? The tech sector is not doing so well anymore. A lot of those rich people, supposedly, on paper, are not doing so well anymore, and they've got interest-only mortgages. Are those going to be repaid? It's a regulatory thing. So we're in a difficult environment. I 100% agree. The oil market is basically just attending to the noise that is there in terms of the financial sector. I think overall we're still in very much the same place. No one really knows what's going to happen next, and I don't know either.
Right, Rachel. Just a quick one back to you. Are there any other names out there apart from First Republic, that might be on the risky list now?
Not, I mean, they're names people are watching. I think the thing I'm worrying about is that not only the rich people in California is this issue, but I think the banking system as a whole in the US maybe has already become a little more picky about what loans they're doing. I mean, maybe not before time. And to some extent, I think just this worry of, we should have expected that when Fed rates went to zero up to, sort of so quickly that would have a meaningful impact on debt service costs and just sort of feed through into the economy. The challenge is, of course, that price pressures haven't fully gone away and those competing dynamics. So I think overall in the banking system, the fact that both there's been a flood from smaller banks of deposits from smaller banks to larger ones, but also investors and others, including myself, taking advantage maybe of high interest, options and pulling out of other things. I think this is something the banking system is still digesting, and we're seeing that elsewhere.
Okay. Osama, you're closer to the action as regards China and Asia, where you are. What's your viewpoint? I mean, especially on the China issue. How do you see Chinese demand panning out for the rest of the year?
Sure. If you allow me, I'd also want to just add a few words into the previous question.
By all means,
that's okay. Yeah. So I believe there has been, if you look in real terms, there has been a 30% fall in oil prices the same month if you compare to the last year. And I believe what happened this week, nothing special happened this week, of course, apart from some economic data coming out. But I believe this is a reaction which is reminded every now and then to the investors, to the speculators, that there is an underlying weakness or a slowdown in the global economy. And to see this, you have to go out of the oil markets and look at other indicators. For instance, I just did a post on LinkedIn about the world trade, merchandise trade, which fell about 0.9% recently. Cargo at London fell about 9%. The global freight volumes fell the fastest in the past 30 years. That only this news item speaks a lot about where the global economy is standing at the moment. You look at the ISM indices in the US, you look at the PMI indices, manufacturing especially, all of them are trending downwards, while the inventory sentiment index or the leading economic index recently by the Chicago Board Conference, all of them, they give one message that there is an underlying weakness in the global economy. On the other hand, I believe that oil prices they had a bit of over-representativeness of unreal expectation of a demand surge from China,
right?
From global economic recovery. But when you look at the fundamentals, if you look at the physical markets instead of the paper markets, there wasn't any surge in demand instead, and there wasn't any supply concerns as well. That is why the OPEC plus decision was quite wise in its timing. We see that the seaborne oil loadings from Russian ports are at their multi-month high. Everything is going fine. Coming to China now, when we speak about oil demand, China's imports have risen, oil imports have risen, but so has their exports. And there was a very interesting article by Clyde Russell and Reuters. I follow that him, weekly, because he has this wonderful insights, and he does this calculation, and that calculation, that calculation shows that more oil is now going into the inventories, despite China buying more, and the exports are higher. It means the domestic demand is not as high as it was expected to be. And in the coming months, we also can expect China to tap into the inventories instead of buying more oil from the markets.
Yes.
So all of this, I believe, points out, and I've been bearish on oil from the past few months or something. I believe, I keep saying this, that the chances of oil prices hitting maybe 65 or falling below 70 are way more than it climbing back to 100. Of course, any geopolitical flashpoint can take it back there, but that might be temporary. So that is why I believe there has been a sell-off in oil prices recently.
I keep hearing it said that there is lots of oil in the world, and I guess we're going to find out in the next few weeks whether that's true. Stay on this supply and demand subject for a moment. In early June the 4th, I believe, is the next full ministerial meeting of OPEC plus. They have shown in the past, of course, that they can act outside these windows. Most recently in the big cut in early April. But that's the next chance for them to do something in a concerted, cohesive way. Very quickly, the three of you, will they cut in June or will they cut before? Just a real quick run around the room here. Rachel?
So I think we're still waiting to see some countries, and I think Russia, Osama already highlighted as the one we're sort of watching, see whether they actually cut as they've already pre-announced they will. Yeah. And we might see a little bit of that. I think they might cut a bit more, but I think ultimately this is going to be a story of actually committing to the cuts they've already done. And I do think the big thing out there, I know that, this wasn't as quick a fire round as supposed to be, but this real question of the burden sharing within the sort of countries that can cut is going to come into question, and Russia is going to be very much in the frame, and that is the big thing I'm watching.
Okay, Mark.
I think they'll stand pat, to be honest. I still feel that we are going gloom and doom on the global economy. Our problem is our narrative. We keep on swinging the narrative between it's fantastic and it's it's doom and gloom. The problem is what we are is in a sluggish global economy. Asia is actually picking up nicely, and that's probably the most important thing for the oil market as far as I'm concerned. And that Asian demand will start to pick up as we go through. China's part of a bigger Asia story, and I think that's probably the most important aspect for OPEC. And for that reason, I think they'll just stand pat. They've done enough, and as Rachel was saying, it boils down to people need to commit to the cuts that they've made beyond the fact that there are a lot of countries which actually can't even meet their production quotas.
Okay, let's see what prices do ahead of June, because that would probably be a determining factor in whatever action they take then. But Osama, let me go back to you, please, because Rachel touched on Russia. And I read this morning that the Pakistan Prime Minister, Shehbaz Sharif, said that the country was all set to get its first shipments of Russian oil, discounted, of course. Talk us through that and tell us how much more Russian oil is Pakistan likely to buy?
I still have my doubts regarding the materialization of this development, because there are many
cargo. You mean of the cargo?
Of the cargo, yes. I until or unless I see it coming, it is docked, I wouldn't believe it. And there are different reasons why. Because first of all, there is a huge and very serious sort of diplomatic navigation to all of this. Although recently, someone from the government said that they have done this in collaboration, or the US had knowledge of this, so they sort of sought permission from them. But still, so the amount of oil that the Pakistani government aims to buy from Russia is about 100,000 barrels per day. Pakistan's daily energy demand is about 500,000 barrels per day. And we have imported about 156,000 barrels in the past year, on average. So we're talking about, and most of it was from two vendors, UAE and Saudi Arabia. So hypothetically, if we start buying Russian oil to the tune of 100,000 barrels, we are saying that we wouldn't be buying oil from the countries that not only give us oil, but also give us deferred oil payments, that also park their dollars in Pakistan's national exchequer in when there is need, as it is now. So there are lots of different things. I cannot wrap my head around how are they going to manage Saudi Arabia and UAE, both of them, in terms of the diplomatic side of it. Furthermore, the refinery capacity here isn't, because there was a study done recently, and only 5 months ago, none of the refineries said that they are able to refine the heavy grade Russian oil, because our refineries have been tuned according to the different oil, the Middle Eastern oil. And now, all of a sudden, I never read about any, there weren't any developments in terms of that the refinery capacities have been enhanced or anything have been added. And now they say that there is one refinery that will refine the oil. So that is also another thing. Furthermore, it will cost us more in terms of freight costs. I've highlighted this many times before as well. So we'll see. We'll wait and see. But I think maybe
that's a note of skepticism there on this cargo for sure.
And of course, the price as well. They say that the deal is to be done near 50 or 55, but no further details have been made public. So I don't know if it is above the price cap or if it is below the price cap. That's another thing that we need to know.
Well, that's below, of course, but that's a bigger discount than most people, doesn't it?
Yes.
I want to stay on Russia again for a moment, and Rachel, to put this question to you, because it seems increasingly that Western sanctions aren't having as much effect as was hoped in the West at the outset. For example, remember when the IEA said that Russia was going to lose 3 million barrels a day? Well, nowhere near that. Now, much of the pressure and inspiration for these sanctions and the price capping came from the US. And I'm beginning to wonder if there's any body of opinion there in Washington that these have backfired and should be rethought. What do you think?
So I don't know that I don't know that people think they've backfired. I think in some ways this is part of the point Mark was making earlier about expectations and reality and what people were expecting from a political perspective. The other one on the energy side, really nothing that was at all tough on Russia on sort of current energy production, current energy flows came in until the EU embargo in December. And then the price cap, in a sense, was designed to blunt that, right? To keep the oil flowing to the global market. So the evidence I see is, yes, Russian oil revenues are down. Russian gas revenues are down because they decided to cut, which is a bit of a different story. This is the big question in some ways about whether both Russia and OPEC will sort of adjust supply and whether that will allow Russian blends to sort of increase in price. But I do think this secondary goal, this dual mandate in a sense of the price cap coalition of keeping the oil flowing, like that's clearly worked. And that's probably worked a bit better than cutting revenues. And the other piece, of course, that's changed is some of the nature of who provides services to Russia, to sort of that part of the global oil markets. And I think that's something that may have backfired to some extent. Western services are still being used, but if we look out over the coming years, there's some more players. And my apologies, there seems to be some very weird, loud noises outside my window that I hope you guys can't hear.
Well, it's party time where you are, isn't it?
I guess so. Or some sort of weird accident outside the window. Who knows? Okay. I'll report back.
We can't hear anything. But Mark, let me put a similar question to you from a European point of view. You know, some of the sort of loony right in Europe have never really wholeheartedly supported the actions against Russia, Hungary, I'm thinking. Is there any sense that people's opinion is changing in Europe about sanctions against Russia?
I think there are divisions opening up, and as there are divisions opening up about support for the Ukraine, there was always going to be a very diversified body of opinion. That's nothing new, really. I mean, that is the EU. It struggles, as it is with the energy transition, to come with a unified voice, because at some stage, another country, typically at the moment, it happens, the awkward squad happen to be centered around Poland and Hungary, but it's not only them. Germany and Italy are definitely at loggerheads with France. I think for the moment, my biggest worry for Europe in terms of energy, be that with oil, be that with gas, is there is a huge amount of complacency. You know, they've got through the winter. They think their strategy worked, and to be honest, as with a lot, particularly in metals and energy, all I'm looking at is the fact is global inventories have been run down into the ground. We supposedly have huge demand because of the energy transition for quite a lot of things, and we are just one supply shock away from another spike. So Europe is, I think, feeling quite smug, and is also feeling quite smug about the fact that actually energy consumption has been reduced over the winter, but that's actually a function of the weather. That's also true in the United States. So there is quite a lot of smugness, and people are quite happy to a certain extent that the energy prices aren't creating the same sort of problems in inflation terms, which is the most important thing for everybody. But I still think that anyone relying on what we've got at, as our status quo at the moment, still being the case in 3, 6, 9 months' time, not necessarily a good idea.
Okay, interesting. Smugness rather than political reaction. Interesting. Just something that has appeared on the digest this morning. There was this issue of a tanker in the Gulf here that had been seized by Iranian naval forces. The details are a little bit fuzzy. But Rachel, just very quickly, why do you think the Iranians would want to ratchet up these kind of tensions now? They're in the middle of a peace deal, peace talks with Saudi Arabia. Why do this now?
Well, I still think there's a question how much things like that are centrally controlled versus opportunistic. So we'll see what the deals are. I'm thinking about different actors in the IRGC and other sort of contexts. So the deals are. The other is just that this is some of the things that happen when there are, when there are sort of sanctions, when the oil is sort of under the radar. There's a lot of issues in that context. So I think we have to wait and see. There definitely is a lot of potential economic benefits from this rapprochement and ratcheting down of tensions, but these changes don't happen overnight. Right.
Osama, just give me a quick take. These are your neighbors in your part of the world. What's a quick take, please, on the Pakistani view of the Saudi-Iran rapprochement?
I think Pakistan stands to benefit a lot from such a development. We have a lot of energy projects. We have a lot of other projects, power generation projects that were in limbo because of the rift between the countries. But now, as China has sort of made this possible, we stand to benefit a lot. Although time will tell how long this will go on.
Right. Okay.
Yeah.
Let's go to the survey question, please, if we could pull that up. Because we've seen a resumption of the kind of verbal spat between the IEA and OPEC, Fatih Birol versus Haitham El-Ghais this week about the cuts and the effect of the cuts. OPEC says that effectively other factors are the main reasons behind global inflation and economic risk. So the survey question that I would like you to respond to is as follows. The IEA says that OPEC plus cuts policy is inflationary and a risk to global economic health. OPEC says rising interest rates and the lack of energy investment are more serious threats. Who is right? And that's a simple one choice. Please. Right or wrong? Straightforward, black or white response. Mark, what do you think? Who's right?
I'll side with OPEC on this one. The upstream investment issue is a huge one, and it doesn't just apply to the energy market. And the IEA seems to be rather more coming from, I'd say, an ESG standpoint. And as much as ESG is important, it needs to be managed properly. And I agree with OPEC on that front. If we don't manage this properly, we actually could create a huge inflation problem, but it's not actually coming from the demand side.
Okay, thank you. Osama, what do you think?
I agree with Mark and OPEC as well. Yeah, there is a huge issue in oil and gas investment, and being in a developing country, I believe we will need more oil and gas. The world needs more oil and gas, along with the development in the energy transition and renewable energy. But OPEC is right. Yeah.
Right. Okay. Rachel, we have to have somebody to stick up for the good old IEA. Who will that be? You?
Not exactly. I think there's also a time inconsistency sort of point here. I mean, the IEA sort of point, very much echoing. It goes back to what scenarios they're upholding. I think the issue here is just that we need not only sort of OPEC to kind of be trying to think about and communicate short-term kind of market dynamics and how they're balancing, but also what efforts are they really going to do and others going to do to deal with these investment gaps. And that's, again, where I think you get to the divergence within OPEC and OPEC plus. Some countries are doing that, others not able to do that. But I think, look, there's a lot of bad blood, including on those estimates of how much Russian oil was going to come off the market. And that's why interesting to sort of hear what comes out of their sort of joint research sort of meetings on that dynamic. Do they paper that over and the like?
Okay, but when gas prices go up at the pumps, nobody in the States will be blaming the IEA, will they?
They will not. They will not be. They'll be blaming OPEC, and they'll be, And I think, look, there's a lot of issues that the U.S. is not sort of grappling with around permitting reform, and that's an issue not only for oil and gas, but also for critical minerals and other sort of elements of energy security, the green energy, and that's going to be something the administration is going to have to deal with in a way that's not hyper, that is dealing with a political cycle, right? The election campaign has already started.
Yeah, of course. Yeah, sorry, we didn't have a chance to get around to that. I would love to grill you on the election the next time for sure. But the room is of the same opinion as the panel we have today. 86% back OPEC in this and say that the IEA is wrong to blame inflation on increasing oil prices. That's an interesting outcome, I think, or maybe it shows just that we are all oil people rather than environmental people these days. But we have reached the end. I wanted to talk about the IMF visit to Dubai next week to give their Middle East economic report, which I'm told is going to be quite controversial. But we've run out of time, so we will talk about that next week, I hope. So to the three of you, Rachel Ziemba, Mark Oswald, Osama Rizvi, thank you very much indeed for your time today, and hope to see you again soon. Thank you very much indeed. Goodbye.
Thank you so much.
Bye.
Bye. Thank you very much.
Bye.
Have a great day.